Hey everyone, welcome back to Corporate Decoder, where we shine a light on the financial world and uncover the real stories behind the numbers. And today we've got a filing from Bowen Acquisition Corp that's a bit of a roller coaster, so buckle up because we're diving deep into their latest quarterly report. This is essentially a check-in on the company's financial health, showing us their performance for the first half of 2025. Now, before we get into the nitty-gritty, if you're all about simplifying complex financial reports and getting straight talk, make sure you're subscribed. And hey, we've got a growing community over on Discord to break down these filings even further. Link is in the description. First up, let's look at their balance sheet, which is like a snapshot of what the company owns and owes at a specific point in time. As of June 30, 2025, Bowen Acquisition Corp had total assets listed at around $8.5 million. That might sound like a lot, but when you compare it to their December 31, 2024 figure of over $76 million, that's a significant drop. A huge chunk of that has to do with their investments held in a trust account, which has shrunk from over $75 million down to just over $8 million, 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 down to just over $8 million. What's this big reduction in the trust account mean? It generally means they've likely used those funds perhaps for redemptions or other business combination related activities. This is a key indicator of them actively pursuing their business goals or facing financial shifts. On the flip side of that asset coin, their total liabilities also saw a considerable jump from about $1 million at the end of 2024 to over $2.1 million by mid-2025. A big part of this increase comes from something called FPA liability, which is a new liability showing up on their books in 2025. Now let's turn our attention to the income statement, which tells us about their performance over a period. For the 3 months ended June 30, 2025, they reported a net income of about $750,000. That sounds pretty good, but let's dig into how they got there. They had formation and operating costs of nearly $77,000 for that quarter. What's interesting is the significant amount of other income they received, over $27,000. This is largely driven by interest earned on investments and a notable change in the fair value of that FPA liability, something that added over $755,000 to their income. So while they posted a profit for that quarter, a large portion of it wasn't from traditional business operations, but from financial instruments and interest earned on their trust account. Looking at the 6-month period actually paints a very different picture. For the 6 months ended June 30, 2025, the company reported a net loss of over $1.2 million. This loss is significantly impacted by a substantial loss on the issuance of that FPA liability, which was almost $2 million. And also a financing expense of $33,600. This highlights the financial complexities and costs associated with their current developmental stage. Let's look at their equity. The company has 2.2 million ordinary shares outstanding, but what's really important here is the category of ordinary shares subject to possible redemption. As of June 30, 2025, there were around 70-40-2025, there were around 44,000 of these shares have likely been redeemed by shareholders, probably indicating a move towards a business combination or a liquidation event. The value of the ordinary shares themselves, excluding those subject to redemption, is quite small, sitting at just $227. This par value is just a face value and doesn't reflect the actual market value or the company's worth. Now, additional paid-in capital is listed at about $150,000 in June 2025, compared to nothing on the books at the end of 2024. This could be related to the issuance of new shares or other capital raising activities as they push towards their business combination. And then we have the accumulated deficit showing a loss of nearly $2.1 million. This is the total cumulative net loss the company has incurred since its inception. For a company in its early stages, this isn't unusual, but it's something to keep an eye on. Moving on to the cash flow statement. This shows us where the company's cash came from and where it went. For the 6 months ended June 30, 2025, the company used about $86,000 in operating activities. But here's the crucial part. They had a massive inflow of cash from investing activities, over $67 million, which was directly tied to cash withdrawn from the trust account for redemptions. And then in financing activities, they had an equal outflow of $67 million to pay back those redemptions. This really shows the company is actively managing its trust account funds to facilitate shareholder redemptions, possibly as part of their business combination process or in response to an impending deadline. Looking at the notes, we get more context. The company is a blank check company, meaning it was formed to merge with another business. They mention a proposed business combination with Shenzhen Qianji Biotechnology Co. Limited. This is basically the whole point of their existence right now. Now, this is a big one. The report highlights substantial doubt about the company's ability to continue as a going concern. This means there's a real question about whether they can keep operating without a substantial business combination or liquidation. They've incurred significant costs and expect more, and if they don't achieve their business combination goal within a set time frame, they will liquidate. They also note they are an emerging growth company and can use extended transition periods for accounting standards. This is pretty standard jargon, but basically means they can adopt new accounting rules later than other companies. A key policy is how they account for things like their FPA liability, which they classify as a level 3 financial instrument. This means its value is based on unobservable inputs and management's own assumptions, which can be a bit subjective. Now, for some very recent developments, on July 10, 2025, they received a notice from the Nasdaq stock market that they failed to maintain the required minimum number of publicly held shares. They have a deadline to submit a plan to fix this. Even more concerning, on July 15th, Nasdaq determined to halt trading and issued a delisting determination letter. This is a serious warning, indicating the company is not meeting several critical listing requirements, including market value and number of shareholders. They have a chance to appeal, but it's a tough road ahead. The management discussion section talks about their plans. They are still focused on finding and completing a business combination and acknowledge the significant costs involved. They also reiterate the going concern doubt due to their current financial situation and the looming deadlines. Here again, they mention the trust account and how its funds are used. They have limited cash outside the trust account and are reliant on the trust funds for their operations and business combination efforts. The statement about needing additional funds from related parties to cover working capital deficiencies is a crucial point that suggests they might be relying on their sponsors or affiliates to keep things afloat. They also disclosed a material weakness in their internal control over financial reporting, specifically citing a lack of qualified SEC reporting professionals. This means their financial reporting processes need improvement. Finally, we have the exhibits, which include certifications from their CEO and CFO confirming the accuracy of the report. So now for my take. Bowen Acquisition Corp is in a precarious position. They've burned through a significant portion of their trust account for redemptions and are now facing delisting from Nasdaq. The FPA liability and the related financing expenses and losses are a major drag on their finances. While they had a net income in the first quarter, much of it was due to financial instruments, not core business activities. The going concern warning and the Nasdaq delisting notice are serious red flags. Their ability to secure a business combination and avoid liquidation hinges on overcoming these significant hurdles. It looks like they're in survival mode right now, focused on meeting deadlines and navigating regulatory pressures. Unless a very strong business combination and avoid liquidation hinges on overcoming these significant hurdles. It looks like they're in survival mode right now, focused on meeting deadlines and navigating regulatory pressures. Unless a very strong business combination is announced and successfully closed very soon, the future looks uncertain. What do you all think about Bowen Acquisition Corp's situation? Does the proposed